Just going through some of your constructive investment themes, and they're quite interesting. Emerging market debt, you're still overweight US Treasuries being maintained despite, of course, the ongoing debt ceiling uncertainty, and also to buy yen. So I'm wondering, on the whole, what's your risk construct here for a portfolio?
Morning, Heidi. The three ideas that we have are portfolios in terms of our focus, long yen positions and constructive positions on local emerging market currencies, and some of the Chinese equity exposures, and a slight overweight in U.S. Treasuries. They're all supported by our conviction that the dollar is really at the end of its rally. It's quite possible, before the resolution of the debt ceiling crisis, we'll have some choppy environment in the currency markets. By looking at the medium-term valuation for the currency, it's still very expensive, and we believe that we have reached the peak rate in the U.S. And if you combine these two developments together, it will likely see quite a supportive environment for anti-dollar trade, so to speak, in the second half of the year, and these are basically the trades that are consistent with that. And also, in terms of the U.S. economic strength, we continue to receive data that suggests that there's going to be slowdown down the road, and that's supportive for U.S. Treasury overweight, and this is the position that we have in our portfolios.
Markets continue to price perhaps rate cuts coming this year, perhaps because of this volatility. But the numbers today, whether it's jobless claims or producer prices, seem to show that we could be getting some signals of the economy here cooling down. Are markets again getting ahead of themselves?
Initial jobless claims are trending the right way from the Fed's perspective of basically fighting inflation, because the job market shows this signal for further weakness down the road. So we would say that market's not completely wrong to think that we've seen the end of the rate hike cycle in the U.S., but the pricing still seems quite aggressive in our view. This is the reason why, again, the environment will be quite choppy. And keep in mind that May and June period usually not a good season for risky assets. Normally, in normal year. So in our view, it will be choppy because of this aggressive pricing that from our perspective seems a bit inappropriate. But of course, 6 to 12 months from now, we think the dominant chatter in the market will be the prospect for rate cuts in the U.S. We are not there yet, but we'll reach there eventually.